Have you ever had that feeling where you're looking at the world and things just don't add up? You see the economic data and it's telling you one thing, but then you look at the stock market and it's like it's on a totally different planet, sailing full speed in the opposite direction. Well, let's get into it because we're going to unpack a really fascinating theory today about why the market feels so disconnected from reality.
Yeah, this is the big question on everyone's mind, right? The economy feels shaky. We see all these warning signs flashing. And yet, the stock market is just hitting new highs, like it's at the world's best party. It's confusing, for sure. But what if it's not just random chaos? What if there's a new logic, a new set of rules that actually explains all this weirdness?
All right, so first up, let's just stare this disconnect right in the face. On one side, we have some genuinely worrying economic numbers. And on the other, you have a market that just keeps climbing.
I mean, the contrast here is just wild. We're seeing major signs of a slowdown in global trade. Chinese container shipments are dropping. We get weaker than expected jobs reports. And the market, what does it do? It rallies. It goes up. Now, we've all heard the phrase bad news is good news, but when it happens this consistently, it starts to feel like something much, much bigger is going on.
And this brings us to a really powerful idea from the source material. What if the news itself doesn't actually matter? What if the market already knows where it wants to go? It has this built-in momentum, and it just grabs onto any headline, good or bad, as an excuse to keep going in that direction. So the real question becomes, what's setting that direction in the first place?
To figure that out, we have to rewind the clock to a very specific point in time, a moment when it looks like a fundamental rule of how markets work just got torn up and thrown out the window.
Okay, so check this out. For decades, there was a rule in finance that was almost like the law of gravity. When real interest rates went up, the price of gold went down. Simple, reliable. You could set your watch to it. But then, around October 2022, that relationship just shattered. Real rates were climbing, but gold started climbing right alongside them. This wasn't just a small hiccup. It was a signal that the entire operating system of the market had somehow been rewritten. And that is the absolute core of the mystery, isn't it? When something that fundamental stops working, it means a new, incredibly powerful force has just shown up to the party. So, what is it?
Well, this new force has a name. It's called the era of fiscal dominance. And it's all about a massive shift in who's actually in the driver's seat of the economy.
So in the old days, right, the central banks were in charge. They used interest rates as their main tool to send signals to the market. They'd say, hey, we're raising rates, time to be a little more careful. And the market was expected to listen and manage its own risk. But in this new world, this fiscal-led market, the government itself has become the main event. The most important signal isn't interest rates anymore. It's massive government spending and, this is the crucial part, the implicit promise that they'll step in and save the day if things get too hairy.
So put simply, fiscal dominance is when government action, all that spending, all the stimulus, all those safety nets, is so powerful that it just steamrolls the traditional signals from the central bank. The government is basically shouting to the market, don't you worry about risk, we got you. We are the ultimate backstop.
And I just love this quote from the source material. It perfectly captures the vibe, right? It's like the government has snatched the keys away from the Federal Reserve, turned to the market and said, trust me, bro, I'll drive. The implication is that they'll absorb all the risk. And that, as you can imagine, creates a totally different psychology for investors.
So how does that psychology actually play out? Well, it has a huge effect on how the biggest players in the market behave. When you believe there's a permanent safety net underneath you, your whole strategy shifts. It's no longer about carefully managing risk. It's about not getting left behind by the hurt.
This quote absolutely nails the mindset of big institutions right now. Think about it. If you're a fund manager and you bet against the market while it's going up, you're a lone genius until you're fired. But if you just buy what everyone else is buying and the whole market tanks, well, hey, everyone lost money. It wasn't your fault. This creates this incredible pressure to just do what everyone else is doing.
And this creates a really dangerous feedback loop. Here's how it works. It starts with giant funds mindlessly allocating a tiny slice of their trillions into risky bonds just to be diversified. But because they're so huge,
That buying pressure crushes the price of risk. It pushes down things like credit spreads. Then, the algorithms and automated trading systems see those low-risk signals and interpret it as a green light, a universal buy for everything. That pushes the market up, which makes that first mindless purchase look smart, which encourages even more buying. It's a self-fulfilling prophecy. And analysts point out this looks eerily similar to the mechanical, mindless buying of mortgage debt right before 2008.
So, if this theory is right, what are the warning lights blinking on the dashboard right now? Let's take a quick look.
When you look at the data, what you see is a market of extremes. Credit spreads, that key measure of risk we talked about, are at a 27-year low. It's like the market is saying risk doesn't exist anymore. Valuations are priced for absolute perfection with zero room for anything to go wrong. And that bizarre disconnect is still there. Chinese stocks are rallying even while their actual shipments to the US are falling. It's strange.
And then there's this number, 30. The market's trailing price-to-earnings ratio has hit 30. Now, to give you some context, a valuation that high has only happened 2 other times in recent history. At the absolute tippy top of the dot-com bubble and in 2021, right before that big correction. It is a sign of extreme optimism, or maybe extreme complacency.
So all of this, it leads us to one final, really provocative thought. If the government is providing a permanent safety net and these giant funds are basically creating their own reality, is the market even a fair game anymore? This is such a wild idea. The source material basically argues that firms with trillions of dollars in assets are so massive, they're no longer just playing the game. Their decisions literally create the playing field. When they decide to buy risky bonds, they don't just accept risk. Their buying pressure makes those bonds appear less risky for the entire system. They're not just reacting to the market, they are the market. And the analogy this theory leaves us with is pretty unsettling. It suggests the market is becoming less like an open field of competition and more like a modern-day feudal system. You've got these financial giants who are the lords, they own the land, they make the rules, they basically create the weather. And the rest of us, we're just trying to figure out how to live on their land. And that's really the final question we're left with. In this new era of fiscal dominance, where government promises and the mechanics of giant funds seem to overpower everything else, are we as investors really playing a fair game? Or have the rules changed so much that now the game itself is playing us? It's definitely something to think about.